Welcome to Revere Asset Management's Your Money with Danny Stewart
The market will always overshoot to the downside and to the upside.
and Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
I want to talk about behavioral finance 101 because right now this is a tough part of the market when it's choppy and sideways. They call it sideways market, range bound within a channel. No matter what your semantics are, we've had a pullback. And if you want to manage risk, you've got to limit the losses because you don't know. Now, normally the first 5 or 6% is going to be kind of in line with I'm talking about Revere now. It's going to be kind of in line with the market, and you don't want to you got to let it breathe. You want to separate the signal from the noise, like on a radio. Okay? Once it starts getting 6, 7, and it starts getting closer to 10%, we already started taking layers off because you don't want to go all in and all out. You get whipsawed all over the place, especially with kind of the ETF side. And I'm going to let Obi Don explain that a little later. Okay? But once you start hitting close to that 10% drawdown, which we're not there yet, not even close, but when you start getting close to that 10% drawdown, Wall Street defends that because that's technically called a correction from 10 to 20% negative. Once you hit 20%, it's a bear market. Well, 2 out of 3 times to 3 out of 4 times, the market will snap back right around that 9, 10% level. It will come back and it won't go into, quote, a correction or just barely dip through it and come right back through, right? But 1 out of 3 to 1 out of 4, it's going to accelerate and it's going to keep going down and you'll hit a bear market. Then you go down 20, 25, 30, 35% because selling accelerates, right? And so at Revere, we manage risk first and the returns take care of themselves, and price is truth, no exceptions, period. So we've got stops on every stock we own, but even on the ETF side, they're just more, they're kind of short-term, mid-term, and long-term. So the mid-term and long-term are going to stay in there a little longer. But there's a reason for that. Because if you just clear the decks, if you think you know what's going on and you think everything's going to go to hell in a handbasket, pardon my French, and you just completely get out and the market snaps back, now you got a spread against the relative to the S&P where you just gave up 6 or 8%. Whereas if you have some in more passive ETFs or some exposure, so even stocks, right? When you get that snapback, you're going to close that gap from 6 or 8% down to 2 or 3 or 4. That's why Obi-Don Kenobi keeps staying in a portion right now, because we haven't crossed the 200-day, and he'll talk about that in a minute. I'm just trying to talk philosophically, 10,000 square feet view for the pie charts are us people, not the active traders. The active traders get this. They'll either trade and clear the decks, or they'll kind of use our method. But Don actually came up with half the Grotection strategy due to that same problem. He used to love just all grow stocks and do IBD can slim. The problem is you can get hammered on that if you take 10, 12% positions in just 5, 8, 10 stocks when you get a big drawdown. And so the point is that we would rather get stuck out wishing we were in than in wishing we were out, because you're only one trade away or a couple trades away from getting back into the market. Anyhow, when the market goes down 6, 7, 8%, we started getting much more defensive, because at one time where the market goes down 35 and we're down 12, right? That's a huge difference, and that's where people get scared. Okay? But here's the behavioral finance part I'm talking about, because our probabilities, our math and everything has been true and tested. But if you're experienced, see, because gains and losses come in clusters. When the market's going up, you get a bunch of gains. When the market starts going down, if you just got in on 4 or 5 stocks, you'll have small losses because we keep our losses small. But your first experience, if you just came in as a new client, is kind of scary because your first 4 or 5 trades are losses, albeit small. And so you question everything we're doing for the next 6 months, right? On the other hand, if you came in right during an uptrend or even right before that, and we're getting in, and your first 4 or 5 trades are all gains, we got a hall pass for a year, and you think we're a damn genius. And we're doing the same math either way. Now, the way that our strategy works, you give us an uptrend either way, and we are exceptional. Especially in a big downtrend, a bear market, a correction, we protect the portfolios. But even in a strong uptrend, right, where it gets a little harder is when you get in a sideways or range-bound market. Now, historically, they only last 3 months normally, but 6 months at the outside. And right now, Donald let us know, but right now we're within, I think it's about 2.5 months, 3 months. We're right kind of at that cusp of that sideways market, right? But so the question is, this is what I'm going to ask Don. I hope he's ready. I'm throwing him a fastball. How do you manage sideways markets? And again, especially if you want to limit losses, just in case it turns down, not up. But then how do you increase exposure if it all of a sudden starts to rally? Now, so with that question, I'm going to turn that over to Don. We're full disclosure, full transparency here at Revere. But fundamentally, in economic, look, I'm a great economist, and I'm very good at fundamentals. I can do valuations 50 days to Sunday, right? The problem is valuations and fundamentals don't help me make money nearly as much as what we do here, wrapping the technicals into it. And that's because Main Street and Wall Street are not always correlated. In fact, the market normally telegraphs a little in advance. So here's one thing to think about. Right now, the market's a little choppy. They haven't broken down, but they're choppy. Some growth stocks gotten slaughtered. That's why you need to have a sell discipline, right? But it was all about the Straits of Hormuz and them getting closed down and oil spiking up to 95 or whatever it is today, 92 yesterday, right? But if that gets cleared, if they start allowing ships back in to the Strait, and Iran has been whatever happens, all I'm saying is they open up the Strait, you could see a huge rally very quickly. If it doesn't, then who knows? But that's why we follow price and volume. Okay? So I'm going to go to them in a minute. But first, I want to read a mailbag from a trader. And it honestly wasn't a mailbag sent to me. Excuse me. It was a Twitter post that one of the guys found or saw. And this is a guy named Robert Hurst, CPA. And he posted on Twitter. He's talking about the Pie Charts Are Us crowd, whether it's Ray J, Ed Jones, whoever, right? Not sure what point I'm trying to make, but the Edward Jones advisors in my community are a former high-end clothing store salesman, a former commercial condo bathroom counter salesman, an admin at the local hospital, and a youth pastor. Not sure how the admin got the job with no sales experience. Well, first of all, we're not worried about sales experience here. We're worried about technical analysis and following the markets. But when you listen to these guys, that's all they do. They don't have Don had an IT background a long time ago. It helped him learn how to do this. But he hated IT, and he got into this decades ago. I've been in it for 30 plus years. Ted and Connor were doing this in college. That's how they just eat, breathe, and sleep this stuff. So when we go to Don, does he sound like one of the people over at one of the big brokerage houses talking about asset allocation with some random date rebalancing nonsense? Or does he sound like a technician? One last thing, and I'll leave you with this. If you become a Revere client, your money will look just like Don and my money, because our money and our family's money are in these same portfolios, and we do all the trades at the exact same time, at the exact same price at the block level. So everybody gets the exact same price and timestamp. So if you want to learn about our performance, coupled with the lack of drawdown like the S&P, like a third to 40% whenever we hit a bear market, then reach out to Revere, because this is important. And who knows how long this bull market's had a little pause here, but who knows how long this bull market's going to last. So we always say at Revere, any time is a good time to come to Revere, but the best time to come to Revere is before the next bear market. Anyway, with Don, please clean that up and give them technical of what I said.
Well, let's start with the same chart that I brought up last week, which is what dictates our exposure on a percentage basis to the index based on the short-term, medium-term, and long-term levels on the S&P 500. And you really think about this as what is a percentage of the equivalent of a full position in the S&P 500. So 80% actually means 0.8 beta, 70% means 0.7 beta, 50% means 0.6 beta, etc. So these are levels that have been tested going back on our strategy for how long we want to be without throwing the proverbial baby out with the bathwater, because the typical approach with O'Neill, like Dan mentioned, prior, we've made this mistake in the past. I made this mistake in the past in 2021 in the first quarter. We kicked ass in 2020, but the drawdown was larger in 2021. So we've moderated the system since then to accept lower upside and lower downside, because our goal is always to maintain a smooth equity curve, not a jagged EKG-like equity curve. So where are we right now on the indexes? We're in this level here between the 150 and the 200-day moving average. And this is a floor, and it's a floor so that we don't throw the baby out with the bathwater. The market, I say it all the time, never gets into serious trouble until the S&P 500 breaks the 200-day moving average. This is why we keep this exposure. And this is also the time with expanding volatility that you get these big snapback rallies to the upside. So the last thing you want to do is be completely not in the market, get a big move up 1 or 2 days, and then you end up chasing both the index and stocks that have outperformed. That's, right, again, a lesson learned, something we don't want to do. So Dan mentioned how we pull out of the portfolio, and it's a matter of the stops on every individual name. A lot of leaders broke down a week ago today, so last Friday, but it's very clear the names that are still standing out, and these are the names that we're focused on for the portfolio. I texted the guys this morning after the open. We opened higher. These names were substantially higher than the open. They've pulled back a little bit, but we always ask each other, what are the names that we trust right now? And it varies by the market, but what we have in Grotection right now, these 3 names that I trust: Fastly, continuing to make higher highs along with the relative strength. This stock has no idea that there's a correction going on with the market. Circle, another one that had a change on their last earnings report and also completely unaware that there's a correction going on in the market. That's number 2. Number 3 is one that 2 of these Todd talked about 2 Fridays ago, and he's going to give a little bit of an update on it. Again, it's monitoring relative strength versus what's going on with the market. The third one is NET, and a new one is NBIS. We own this in some of the associate portfolio managers' test portfolios. We haven't added it to TurboTection or Grotection yet, but This had a catalyst 3 days ago with a $2 billion investment for expanding their AI data center footprint, and the market is acting extremely well to it. And Todd's going to show a fourth one when he does, or a fifth one when he does his presentation. And it's one he talked about 2 weeks ago. So we're not taking extreme positions in these. We're taking a quarter to a half size position. And where we are in the indexes, let me bring up the S&P 500. We had a gap up failure this morning, and that is obviously not good, but it's another check mark in the negative column of the overall market. We had a gap up on PCE inflation data, came in line. We gapped up, we went higher for the first 20 minutes, and then we turned around, reversed lower, broke yesterday's lows. I've been showing this 60-minute chart a lot. Last Friday, I commented about how it looked like what had been the support level around 67.70 when we broke below it last Friday was acting like it flipped to a resistance level on the way back up. And it did on Friday. In the close on Monday, we blew past it. We made a higher high on Tuesday. Then we started failing. We bounced around there on Wednesday and then broke back below that level on Thursday and haven't tested it again Friday as of noon Eastern time. So below this 67.70 level is it's also a level we've been talking about on the nightly videos. It's a clear risk off level. This is more a neutral level where we might look for higher highs, but we haven't been getting them. The market has given us a series of lower highs and lower lows. We haven't yet broken the 66.36 from earlier this week, and the actual overnight low on the index is the equivalent of 65.80 on the S&P 500. So we're monitoring those two levels. This is also bringing us closer to the 200-day moving average, and we've touched the 40-week moving average twice now. So we're getting to the level that we talk about all the time. The market never gets into serious trouble unless we break below this black line, the 200-day moving average. Now, normally we correct through price, but this has been as much a correction through time as it has been through price, as we went sideways before we really started rolling over for 4+ months now. Just now we're coming into the 200-day moving average, and this will be about 5% off the highs. Normally it's closer to 9 to 10% off the highs. So we're in a situation where we'll break the 200-day moving average, but the damage on the indexes won't be as great as it traditionally is from the bear markets that we've studied in the past. So this is a little bit of a curveball, something new, and we'll react to it accordingly based on lower time frame move averages for maintaining exposure. So really, last Friday, again, talked about how that level looked like it was acting as resistance, and that would be a negative for the market. We got a 2-day fake out back into the range, and now the last 2 days breaking back below that key level, making lower lows, unable to hold the 30-week / 150-day moving average, which is around 67.60. In fact, we actually got as high as 67.33 today, but we're right below that 30-week moving average of 67.60. It's on the 150-day moving average. The equivalent is 67.48. So didn't get back above that level this morning either. So lower lows, lower highs means don't add to your positions. We have a strict rule to keep the beta under a 1 when we break the 20-week moving average, because if you look historically, you see the market bounces quite often at this green line, which is the 20-week moving average. So once you break that level, risk picks up a little bit, doesn't get extremely high until we break the 200-day moving average. There's actually some studies about the 240-day moving average that I'm going to dive into a little bit more, but that 240-day syncs with one of our rules back to that level. This is that 2 ATR level that kind of syncs in with that 240-day moving average historically. So We still will maintain very small exposure, and that's mainly because of you switch from a situation to where the in a healthy market, it's more of an escalator up, elevator down with sharper corrections. When you pull back in a bull market, normally here you trickle lower in a bear market, but you get sharp moves down as well as sharp moves up, which is why that whole old shtick about what if you miss the 10 best days, that's garbage. Those 10 best days move always, not always, there are no always in the market. 90% of them are when you're in a weak market and they're just slingshot snapback rallies tied to headlines and emotion, which is our process. We attempt to take headlines and emotion completely off the table and just go by what's going on, what's actually going on. And leaders weak, check. Indexes breaking levels. Well, we broke the 20-week, we broke the 30-week. Now we're testing the 40-week. Check. Take a little bit off each time. Wait for the market to settle itself. One positive is that seems to be completely headline driven, and it's a headline that could be fixed in almost overnight or in a couple of weeks, because it's not a serious economic shock. The price of oil, granted, trickles in to everything. It hits people's pocketbook. It hits businesses. But this is a geopolitical event that's more or less localized to what's going on, and it has impacts throughout the world. But it's something that could possibly be cleared up fairly quickly, as opposed to something like the Great Financial Crisis or the bursting of the tech bubble or COVID, which were completely worldwide events with massive uncertainty. The VIX has had some spikes, but it hasn't had the massive spikes that we've seen from some other fears. So what's the bottom line of all this? From a Revere standpoint, we're going to maintain some, albeit smaller, index exposure. We're going to maintain small positions in the leaders, the few leaders that are really standing out to us that we mentioned, and we're going to keep our watch list fresh. And our watch list can be your watch list if you follow our Monday videos every Monday, a 21 over 21 and a turbo 12. 33 names, all that you really need to monitor, the health of those names, how they hold up to various levels, will tell you everything you need to know about the potential for leadership in the market if the market rights itself. And what we saw on Monday with that strong bounce was that these leaders came back strongly and for the most part have not violated those Monday lows. That means that they're showing relative strength against the indexes. That gives us some confidence in our leaders list going forward, assuming that, of course, the market needs to right itself. The M in market is the most important letter in CanSlim. To me, the second most important letter is the N, because the N indicates the names that are holding up without exception. They will, if they're growth stocks, they will have something new, a new product, a new service that people want, businesses want. And that's what we look for. And we're patient. We're being extremely patient. There have been 3 days with no trades this week between the portfolios. And that's the situation that we're in. We'll maintain this index exposure and wait for the market to show its hand one way or the other, to the upside or more to the downside, in which case we'll take off more, always keeping our leaders list fresh. And especially our true leaders list, which is those 4 or 5 stocks that I mentioned earlier that we're really focused on. But some could come completely out of the blue. Some could fall off immediately also. For example, CCJ had a big shakeout this morning, but it's bouncing off the low of this flat base that it's putting up. So this is one, basically what this means is you can't trust it. Big intraday shakeouts. You don't want a position in a stock that we can't trust in a below average market. We'll stick just to the ones that are showing massive relative strength, but we'll keep others on our list that are possibilities if the market rights itself. I mean, this has the fundamentals, and uranium and nuclear power for data centers and really across the U.S. across the world for cheap power is certainly a theme that continues to be hot. So Dan, questions on that? And also I emailed you a mailbag that you missed that I think we should address. Anytime anybody's benefiting from our approach from a standpoint that they actually go out of their way to email us, I think we want to talk about that.
Well, go ahead and read it. Do you have it in front of you?
All right, I do.
I missed that one. I'm sorry.
This came from we'll say KG. He says, Don, just wanted to send you a quick note of gratitude as the market insight. You and your amazing team. It is an amazing team, by the way. These guys are just really next level. I've been extremely blessed to hit home runs with the guys that we brought on board. You and your amazing team provide daily has made a huge positive impact on my trading journey. I've been at it for 14 months now and have been able to become consistent in my process with help from your team. I use the 21/21 and Turbo 12 as my main watch list, and I'm making great progress in my account. It's very admirable that you and your team are so open, transparent, and generous with the knowledge and analysis that you share. Please pass along my thanks to Dan, Todd, Ted, Connor, and special kudos to Jackson for his excellent insight on the podcast 2 weeks ago. Sincerely, KG from Victoria, British Columbia. My response: we love hearing from traders that are benefiting from our process. A sound system plus consistency equals success. Stories like yours are why we put in the extra effort. Thanks for the kind words. You made the mailbag this week, Don and the team. That's why we do it. The kudos we hear from clients, it makes it all worthwhile. Anybody that's been a longtime listener is very aware of why we do what we do, what drove me in creating an advisor that has a downside protection was my father-in-law 25 years ago, dying from cancer while one of the big brokerage houses ran his portfolio into the ground with no protection whatsoever. And the more people we can get out there and take that one element out of their retirement dreams. The one element being not getting hit with a 4x4 to the back of the head if the market goes into a serious correction. Those are the people that we're extremely proud to be able to help, and we want to help as many of them as we can.
All right.
Well, so Dan,
okay. So
you always have comments. So
yes, I've got a couple questions.
Let's clarify.
Okay. So you talked about the 21/21 and the Turbo 12, right? So the question is, even though you have that list, not every one is actionable, right? So they just qualify. So how do you pick the best out of the 21/21?
A combination of how they're acting up, what sector they're in. We always keep it diverse, so they're not going to be the 21 absolute best stocks in the market. I mean, there's sometimes when we could have put 21 semiconductor stocks on there. That doesn't help anybody.
Right. But then you get hit by 2x4, right?
Right. O'Neill says you don't need to get diversification through emerging markets, international real estate, etc. You get it through various sectors within the U.S. market. So that's why we always make sure there's at least 10 sectors of the 21/21 list. We could very easily have put the 5 fiber names and the 4 memory names in every 21/21 list, but just having 1 or 2 that represents the sector is what we need. We also want to monitor lack of breadth or breadth if we see all these leading names go up. And it also tells us sometimes we put something on there that's just because we want to keep an eye on a certain sector. Like we'll put GDX on there instead of an individual gold stock name because those tend to move in sync with each other. So we want to keep an eye on individual sectors, and that's the best way to do it is that diverse list.
Right. Okay. So, folks, what he's saying is we're going to have a certain amount. We're not going to get too overweight in any one sector, right? But we're going to pick the best of the best stocks out of the strongest sectors. And we're going to leave alone the worst 30 or 40%. Don always says you don't go to the grocery store and buy rotten fruit for a balanced diet. So you want the best sectors, and then you want enough diversification, although with the sell discipline, so that one or two stocks doesn't cream you. So with that, I've got the question I have is, does your counter salesman or your hospital admin advisor sound like that? Or does he sound like, or she sound like a market technician? That's a question. Anyway, go ahead, Don. Let's see what the team has.
All right, we're going to go to Ted first, and he's got he's going to reinforce a concept that O'Neill used to talk about all the time, and it comes true time after time after time, and it's relative to the U.S. dollar in this case. Take it away, Ted.
Thank you, Don. Dan, you started off this podcast talking about behavioral finance. Well, let's talk more about behavioral finance. This is one of the funniest examples to me of how the media is a reflection of public sentiment. If you think about it, what does the media do? The fundamental, main reason is to gain clicks, right? That's how the media makes money. So when they put out these cover pieces on their magazines, and they write new blogs and stories, and when they're on TV as well, they want to cater towards what the public is most interested in. That happens in politics and definitely financial markets too. And so the dollar made a huge move back. I believe that's the 2020 into 2022 period. Pretty much just really nice trend above the 10 and 20 weekly moving averages. And then you can see Barron's put out an article October 10th, 2022, with George Washington popping out of the dollar, flexing his muscles, and the title was The Powerful Greenback. Well, you can see the top of the dollar was about 2 weeks before. More or less, that was the top of the dollar for the next few years. And pretty much the dollar has gone nowhere except down. We had some choppy ranges. It tried to reemerge into the uptrend, but then it fell back into a downtrend. And a few weeks ago, Connor also posted on X, The Economist put out this piece, pretty much just slamming the dollar, called The Dangerous Dollar with the Serpent on the page. And that was pretty much 1 week after the lows of the dollar. And right now, back to the stage analysis concept I covered last week on the podcast. Again, I mentioned the stage analysis methodology and technical analysis works in equities, ETFs, currencies, commodities, crypto, fixed income, all the assets. And you can see this perfectly on the dollar as well. In that previous cycle, you were in a downtrend. Then it went sideways for a little bit before emerging to uptrend above the 10, 20, 30, 40 weekly moving averages. And then eventually we cracked and went to a downtrend again. And right now, we were just in a downtrend for the last 6 months to 1 year. Right now, we're starting to poke our heads back above the key moving averages. This is the US dollar index, so I don't have the volume with me, but if I had the futures, there was some pretty big volume last week breaking above the 10, 20, 30 weekly moving averages. And now we're at a really critical spot, the $100 level. You can see that horizontal line going across. That was a major low a couple of years ago as well. I don't have the timeline or the dates on the chart, so I'm just trying to go by memory here. But right now you can see there's that horizontal line. Don, if you can just even use your cursor, that one resistance level that the dollar is pressing up against. Yeah, that's perfect. If we break above that, you can label it as entering a new stage 2 uptrend, especially above all the key weekly moving averages, price structure, higher lows, and then could make higher highs if we continue to break out from here. And if you look at the media the last months, even last year, the chatter is all about the dollar is going worthless. Even if you listen to someone like Ray Dalio, who has a lot of merit in building one of the biggest hedge funds in history, he's been talking about de-dollarization as well. He's been talking about potential global reserve currency moving away from the dollar. Gold is a better asset, but we've seen the dollar go sideways, refuse to make new lows, and now are potentially looking to make new highs. So this is just a perfect example of behavioral finance here. At the top, you have the best of news. At the lows, you have the worst of news, and oftentimes the media reflects that. So I guess the bottom line is the media is not your friend, especially in the financial markets.
Yeah, and this support and resistance concept, Ted, goes exactly with that 60-minute chart of the S&P that I showed. How many times do we come down, test that equivalent of that 6770 level, bounce off of it, undercut it, get back above it a little bit, but then break back below it? So we're really about right there. If you compare that to what's going on in the S&P 500 from a support resistance level right now. Now, sometimes you get right back above it quickly. Sometimes you bounce around below it for a while, but at Revere, we're ready for anything to dial up or dial down our exposure levels, depending on what's going on with the actual market. And there is no better example of behavioral finance than this chart right there. Kudos, Ted. Nice job.
Hey, listen, one more thing. So a lot of times these financial magazines try to fill in a story after the fact. They missed the move. They missed telling you in advance this looks good or this looks timely, like we do every week, right? And things go up, and then they try to fill in a story. They fill in a backstory to explain what is happening, and they assume it's just going to keep going up. But it's almost like listening to Jim Cramer on CNBC. You want a contra periodicals portfolio. You don't want to follow the financial media. They're meant to sell you fear or greed so that you take action. You do something. So we try to ignore the media. Sorry, go ahead.
Another example is everybody late last year was talking about how the Mag 7 was completely responsible for all of the strength in the market. And then what happened? If you look at the NASDAQ 100, the Mag 7 topped on a relative basis last year, completely underperformed on a relative basis. People started calling them the lag 7. And now again, 2 weeks ago, it has started outperforming on a relative basis. Whether or not that's going to continue, we're not going to predict. But that's another classic example of it. Late last year, the Mag 7 is completely holding up the market. The other 493 stocks, they're not even worth owning. And then breadth expanded exponentially, and RSP, the equal weighted S&P, put in a bottom on a relative basis in October and has strongly outperformed going into the end of February. Then everybody starts saying that the equal weighted is where you need to be. And in fact, we bought some equal weighted S&P over about 2 months ago, and now it starts to lagging, and we're working our way out of that. It's every time everybody gets on one side of the boat, it's either got to tip over or it's got to regress to the mean.
Right.
And most often it regresses to the mean. All right, let's go on to Connor. He's going to talk about the Fab 4 memory names and give us an update. Take it away, Connor.
So when Don was saying, in a choppy market, we always want to keep our list ready. And one group that continues to stand out significantly is the memory stocks. And we will start with SanDisk right now. And you can see last week, it looked like it was breaking down. It closed at the lows of the day below the 21 EMA on decent volume. And then the following day, it put in a very big reversal, took out prior day highs, bounced at the 50-day moving average and the 21, and it had 3 strong days up in a row. And what it's doing today is actually perfect. Pulled back yesterday, now it's putting in about a decently tight inside day, and you can see that relative strength line is reconfirming above the 21 EMA as well. And also, it looks like this relative strength line is on the verge of breaking out before price, which is also something that is very notable. You see that in the strongest of stocks in a weak market. And so it's, that's telling you that this has a lot of relative strength. And again, this stock just, it continues to be extended, but every time it has a big move, it puts in another new base. This base kind of reminds me of the one back earlier this year, the January breakout. Had a super strong move up, went sideways for a while, tagged the 50-day moving average, and then broke out. So, it looks really good. It's holding up well, and now it's just a matter of the market getting a little bit more healthy and finding a low-risk entry spot. And then the next one is Micron. This one also looks extremely attractive. And thing that stands out the most is relative strength line new highs before price. So this is actually holding up better than SanDisk, and you can see this is rare to see in this type of market. And this one has a very similar setup. It looked like it was breaking down, below the 50-day moving average, and then buyers stepped up. And again, you tend to see this in names, and it's actually good. It shakes out the weak hands. And so put in an upside reversal there off the 50-day moving average, had 3 days up nicely, and now it's breaking out of that little consolidation. And it's also always positive to see multiple different names in the group that are acting well also. So you have SanDisk, you have Micron, and then another key thing to watch is what Korea is doing. This is a good proxy for memory. And if you just pull up EWY real quick, Don, this is, good to track for sentiment on the memory trade, and this has seen a lot of volatility lately. South Korea markets run a ton of leverage, but this is holding 50-day moving average, and some of the big names, like Samsung, SK Hynix, they're big memory names. So it's good to watch this ETF for a proxy on the memory trade. And then the other two, so I view Micron and SanDisk as the leaders, and then the two other names are Western Digital. And these ones just are a little bit more choppy. They're not as liquid. They don't have as much institutional support, and they don't trade as linear as the other ones. But nevertheless, they still look good. Western Digital held the 50-day moving average, and it's starting to curl back up. You had that RS line curl back up through the 21 as well. And as long as all these are holding up, it should bode well for the group. And then the last one is Seagate, STX. And this one also a little bit choppy, like Western Digital. This one is kind of got a power 3 setup. You have the 821 and 50-day all pretty coiled up. RS line into an RS phase as well, and kind of poking its head against a downtrend line there from the highs. So SanDisk and Micron, to me, are the leaders, but it is worth watching Western Digital and Seagate for sentiment and just clues on the overall group. So that's the memory group acting extremely well, probably the best sector in the market right now. And if the market starts to bounce, these should outperform.
Yeah, and those four are a great example of what I talked about with how we saw big strength in the leaders on Monday. These are all four of those are above Monday's highs. Compare that with the S&P 500, which poked its head above Monday's high intraday and is now closer to the bottom of the range. That's relative strength. That's what you want to look for. The odds are that those names are what will lead the next uptrend when the market decides to bottom and go up. Unfortunately, today, this day 5 of the rally attempt, we were hoping with this gap up that we might see a possible follow-through day, but we're absolutely not getting it. And if we undercut the low of Monday, which was on the S&P, which was 66.36. Today's low right now is 66.41. We undercut 66.36. That'll reset the day count for the S&P rally attempt. Thanks, Connor. Let's take it on to Todd, and he's going to give an update of those three names with the big N that he first talked about last Friday. And how have they held up since then, Todd? I think you're probably going to tell us that they've held up pretty well. Take it away.
Yeah, as we approach a potential new follow-through day, we're always wanting to stalk the ones that are holding up the best. And this area presents a major new factor in the AI complex. They're all in this category called originally content delivery networks, and these have been around for decades. And basically what these companies all do is they're specialized layers built on top of data centers that are geographically closer to the end user, and it provides a much more seamless experience between the end user and various AI that the end user is demanding now. And first, AI started with large language models. Now we're moving on to inference and agentic AI. And frankly, those require low latency computing on the edge of that network so that these agents can think and interact off that data center closer to the end user. And that is why all these things are recently exploding, because this is the next natural progression of AI, this agentic AI that everybody's using now. So let's start with FSLY. FSLY is a huge turnaround play that's being repriced and is yet, at this point, to show that it's done getting repriced. TurboTection bought this right on the gap up day. Protection, put this position on, and it's yet to close below the 8-day moving average in a market that's been very tumultuous. This is just incredible relative strength that virtually nothing else is showing. So clearly the institutions are highly interested in this area, and FSLY is the new turnaround play in this area with a big focus on security, and that security is growing very rapidly. So the second major player is NET. NET, which is really the biggest of all three of these players, and primarily focused in the security area. We talked about how this one popped its head above the 200-day moving average a couple times and got knocked down, had this final undercut and rally after earnings, and now is just showing tremendous relative strength with multi-days up in a row, giving a little bit back today, but reclaiming that 200-day moving average and just possessing tremendous relative strength, and finally looking like it is now going to trend and stay above this 8-day moving average, which we look at. So I know Grotection's in a very small starter position in this, and we will see how this sets up above the 200-day moving average, which it finally has been able to show multiple days above it. And finally, AKAM, which traditionally is the largest content delivery network that's been around since the 90s, also showing its place in this area, as this relative strength line is also just heading up straight to the right side of the page, and had a little bit of a pullback to the 50-day moving average after earnings, but quickly gathered steam and is showing tremendous relative strength again in this market. So these were three names we all talked about on the week FSLY broke out, and these are all the three major edge computing plays. And this area is definitely looking like the next progression of AI. And that's the final phase of the major AI build out. Thanks, Don.
Great stuff, Todd. 3 great presentations, and that'll wrap it from the tech team. Dan, you can take us on home.
Thanks, guys. Listen, folks, if you like what you heard, please tell a friend, tell a neighbor. Just send them to revereasset.com. Up in the right-hand corner, there's a subscribe button, our newsletter. We do a daily short video every evening the market is open, going over the short-term, mid-term, and long-term strength of the major indices. And then we actually go over the individual stocks we're tracking, but also anything we did in the portfolio that day for clients. We're the most transparent advisor probably in the world. I don't know of any other advisor putting out content every day, because these guys put out content even on the weekends. Next to that is a contact us button, where you can actually send me, it'll go to me and some of the team that you want a complimentary portfolio review, or you're interested in becoming a client. That's how to reach out for that way. YouTube, if you go to YouTube, just type in Revere Asset, and then hit subscribe. Zach will be done with this newsletter in about 12:30 Central, and it'll be posted on YouTube before the newsletter goes out tomorrow morning. So there's 2 ways to get our content. They come at different times. But then you can find out everything we're doing. We're fully transparent. And you can always call us at 855-REAL-WEALTH. We'll talk to you next week on your money, not Wall Street's money, your money.
Because it's not how much you make in the markets, it's about how much you can keep.